Index measures financial across 23 countries on the continent, Zambia inclusive. The index is benchmarked against 6 key pillars, namely market depth, access to foreign exchange, capacity of local investors, market transparency and regulation, macroeconomic opportunity, and above all, enforceability of international financial agreements. Zambia was ranked 7th best and two-notch improvement from previous year's ranking. However, overall score was down 2.51 out of 100. And cited was revival in investor confidence that gave a cue to government securities market. However, Zambia is in the labyrinth of a debt restructure, given pandemic amplified fiscal fragilities that were existing even before the COVID era. Copper producer is also experiencing record high copper prices, but at the same time did experience a series of defaults on its coupons, on its dollar bonds. Record market backlogs in FX, impacting the ease of doing business. More recently, a shift in the political risk landscape in the wake of the outcome of the August polls. Copper prices on the London Metal Exchange have levitated to decade highs, supported by a decarbonization global drive towards more climate-sensitive initiatives. African financial markets have seen a fair share of product innovation in the period, and a smarter green type of deal structure as the world races for sustainable development goals and the green bond era to save the planet. 10 African countries have reported sustainable products ranging from green bonds to sustainable exchange trading funds. Before I get carried away, let me remember to mention that we have an exciting panel discussion that will do justice to the index, highlighting what it means for Zambia from a comparability with peers perspective to specific pillar performance. This panel has top regulators, economists, and analysts that will educate us on the mechanics of the AFM index. I will now hand over to one of Africa's finest global market heads, the one and only Stanley Tamele, to give some opening remarks. Stanley, over to you.
Thank you very much, Sonia. And good afternoon, everyone, distinguished panelists and guests who are online with us today. I'd like to begin by recognizing the presence of my Managing Director for Absa Bank Zambia Limited, Mrs. Mzingamela, who is not here with us physically, but is on the call with us and will be with us throughout the entire duration of this conversation. Also to recognize the presence of all the guests who have dialed in. The Absa Africa Financial Markets Index was launched in 2017 in Washington, D.C., and was a collaboration between the Official Monetary and Financial Institution Forum and the then Barclays Africa Limited, which is now Absa Group Limited. The idea behind launching of the index was really to try and push the development of financial markets all around Africa, starting with Sub-Saharan Africa, and now it's extended to some other countries which have been included in the index, and to try and shape the way in which policy will go. The idea was to take Africa out, make the financial markets competitive as they would be on a global scale or on a global standard. So that is the idea behind that collaboration. And here we are. I'm excited to be part of this exciting panel that will be presenting the 2021 edition, the 5th edition of the Financial Markets Index. Now, for us in Zambia, this comes at a very opportune time that we're launching this 5th edition, because we've had a change of government recently, and as the expectation goes, there would be some policy changes. And at the same time, we've also had the presentation of our national budget. And with the budget having been presented by the finance minister, some clarity has started coming through around where we see things going, where we see policy going. Also interesting to note is the introduction of other ministries which were not present before, like SME or indeed the sustainable area of the green economy, which has become quite topical and will form part of this conversation as well. So without further ado, I'd like to welcome you all once again and really look forward to us having an engaging and interacting session where the key issues can be brought out. And as I like to think about the index as a barometer, so that we can also see how Zambia has fared over the last 5 years to see where we are now in terms of development. Have we really implemented some of the things that we said we'd do? And what are some of the areas that we need to do as we walk away from here in terms of development? So with those few remarks, I'll thank you and I'll hand back to you, Mr. Moderator, for the next part. Thank you.
Thank you very much, Stanley, for those remarks. So, like I said, we have an exciting panel discussion. But before we delve into the actual discussion, we have a presentation from the Absa Africa Head, Macro and Fixed Income Research, Jeff Gable, who will do this presentation, of course, in conjunction with Stanley. Yeah. So over to you, Jeff Gable.
Thank you very much, and thank you all for this opportunity to speak. As you can see, I'm not able to attend in person. This is getting to be a little bit frustrating. As you may not be able to see, I'm trying to channel as much of Lusaka as possible into my surroundings. You might not see it there, but if I'm able to show you the temperature in the room I'm in, it's 32.1 Celsius here in my office. So I feel very much like I'm visiting to you in person. Judging from the guest list, many of you have been with us in the African Financial Markets Index from the beginning, but it's also great to see some new faces on the list, particularly those following the event through various social media. And so I thought maybe to add a little bit to the opening comments, particularly from Stanley, just to give a quick reminder of what we're doing here, right? The starting point for the Absa African Financial Markets Index is that sort of effective financial market development can best ensure that Africa is well placed to attract global capital, but just as importantly, Africa is at a great place to encourage the effective use of its domestic financial assets as well. And to do that, we thought that getting together African regulators and policymakers, the exchanges, the providers of capital and the users of capital, to get them together and discuss how to best be served by a financial market ecosystem that's open and transparent and accessible. And so our strong conviction is that as the economies of Africa look to recover from the ravages of the global pandemic, that this effective financial market development has never been more important to ensuring sort of an improvement in the livelihoods of all Africans. So as our partners, with our partners in the exercise, with the Official Monetary and Financial Institutions Forum, ONFIF, and Absa, we did is we looked to provide sort of a data set where countries can easily be compared, where we can generate discussions and debate and learnings, and all that can be sort of encouraged. As a collective, we can really push forward. And events like today, with all of the various stakeholders together in one room or sort of pulled together virtually, is such an important component of that. I'm going to share my screen here for a moment because you'll know that, for those of you who've seen me before, that I sort of love slides, and here we go. So before we really get to the index scoring itself, I wanted to highlight just a few of the qualitative aspects that I think really make the report very, very valuable. So first in here, despite all of the challenges related to the global pandemic, it's quite clear to me that financial market development still remains a focus across all of the index countries. And just to pull a few examples from sort of the big list in front of you, if we think about sort of the topic of early market development, those countries that are much closer to the start of their financial market development journey than Zambia is. We have examples like Lesotho, where they're preparing to have the very first company list on their equity market, or Ethiopia, where Parliament has passed a proclamation, a critical one, that should allow for the creation of a securities exchange. There's lots of work being done across the continent to facilitate retail investment. So, for example, in Malawi, the stock exchange has launched a WhatsApp portal where would-be investors can learn about how the process of investing can be done and gain sort of basic information on the companies that are listed there. There's been great developments around long-term financing. Kenya, nearly $3 billion, $750 million in a 21-year infrastructure bond, and the developments of local markets. Tanzania, staying in East Africa, pushing their domestic bond market out to 25 years. And then, of course, there's topics like just improving the smooth running of the markets that exist already. And here, I want to highlight sort of progress in Zambia since the last time we met virtually with the establishments of the Capital Markets Tribunal. So there's an awful lot that's going on here. The second broad topic that I want to mention, or innovation, is just around sort of digital fintech, those sorts of things. Certainly what we've seen across the continent is a lot of work in terms of introducing more automation, digitalization of trading platforms and regulatory processes, the things that really make markets work more smoothly, efficiently, and make it cheaper for capital transactions. All of this is sort of covered in the report on pages 21 and 22. We know that stock exchanges are doing a lot of work to boost retail participation. For example, online and mobile trading, right where you are in Zambia. We know that a number of countries have introduced regulatory sandboxes for fintech and innovation, where Kenya's capital, so for example, Kenya's capital market authority is particularly active in that space, looking to see that new types of financial products and development can really work well within the regulatory environment. And then, of course, there's digital currencies and assets as well. You will all know that just a few weeks ago in Nigeria, to much fanfare, launched the e-Naira. The other area that we're really excited about is just around adding ESG. So for those of you who looked at last year's report quite carefully, you know that we included a box to talk around sort of developments that we've seen across the continent. Well, we've been able to formally introduce ESG into country scorings for this year. We're very excited about that. It's had a big impact on scoring as well, but of course that's rather an outcome rather than it is the goal here with regard to including it. We've included ESG in two areas in the index. So loosely speaking, we've in the first pillar of the index, which is around market depth, we've included sort of the availability of different types of products. And in the page in front of you, that's really the top 5 rows in this table, where we're looking at green or sustainable bonds and equities and their related products. And on that side, I'm really pleased to highlight how Kenya and Morocco lead the list in that space. South Africa and Ghana sort of hot on their heels in 3rd and 4th places. But it's also an indication of just how much more can be done here. Just 9 out of the 23 countries in the index scored above the minimum on this measure. So there's an awful lot of low-hanging fruit for subsequent editions of the Absa Africa Financial Markets Index. And certainly that includes Zambia, where for the launch that we're speaking about today, we haven't seen much activity on actual green issuance. The second place that we include ESG is in the 3rd pillar, which is around the regulatory environment, where we reward countries that have sort of sustainability-focused policies covering ESG assets. So Zambia is a great example of that, whereas I understand that registration fees are reduced significantly for green bonds. It's around integrating ESG into financial market standards. And again, Zambia scores well in that space. And then the final component that we have in the 3rd pillar around ESG is really quite forward-looking. It's around sort of climate stress testing. And we know as we sit on the sidelines of COP26 that there's so much discussion about how all of us, beyond carbon, can think about sort of the long-term sustainabilities of our economies, of our livelihoods, of our business, and of our financial system. And here, I suppose South Africa has taken the lead. It's the one country in the index that has applied climate stress tests already. But broadly speaking, 13 of the 23 countries at least scored above the bare minimum in these measures, and I'm very confident that we're going to see further improvements in the periods ahead. Now, how do we generate the scoring in this space? We heard a little bit of this in the moderator's opening remarks, and certainly as we sat down back in 2017, as then Barclays, now Absa and OMFIF, and tried to design the index, we quickly worked out that there's no obvious simple way to measure the openness and transparency and accessibility of these financial markets. So as we heard already, we've organized into 6 main themes or pillars. The full description of all the measures is in the inside back cover of the physical report. But broadly speaking, there's more than 40 concepts here, looking in a broad way about depth and access to foreign exchange, thinking about market transparency, tax, and the regulatory environment, the depth of local investors, the macro opportunity, and then sort of the enforceability of global standard master agreements. So there's an awful lot there. As I say, in that inside back cover, pages 42, 43, for those of you the PDF report, you can really see the detail in that space. A lot of the data that we pull from is publicly available. But there's also stuff there that OMFIF, our partner, reaches out with to conduct surveys across the countries. There, the survey answers benefit from the hard work of contributions of more than 50 individuals and organizations. And some of those, no doubt you'll see on the panel and in the physical audience today. So thank you on behalf of OMFIF and Absa for your participation on that side. You'll also see, away from the actual scores, that throughout the report, there's lots of sort of market color. People from country A saying, you know what, this sort of thing is working really well, but we look across to country B and we think, gosh, if we could just have a little bit more of that here, that would really free up the openness, transparency, or accessibility of our markets. But I'm mindful that I've already been talking probably 8 or 9 minutes, and I haven't even mentioned the scores yet. So let's turn to that. So the headline focus is often just on the rankings itself, right? It's on the very headline measures. Let's get that out of the way. As you heard already in the introduction, and as you can see on pages 7 through 9 of the report, the top 3 scoring countries remain unchanged this year in placing. It's South Africa leading the index, followed by Mauritius, second place for the 3rd straight year. Nigeria consolidates its first trip to the podium last year with a 3rd place again this year. Interestingly, though, all 3 of those countries, and after on the left-hand side on the screen in front of you, the parentheses after each country, that's the score out of 100 for that country itself. So of not just for the top 3, where scores fell, for 19 out of 23 countries in the index, scores fell this year. Now, we're going to hear a little bit more detail around Zambia's scores specifically as Stanley takes up the baton from me in a moment. But the country jumped up 2 places, improving from 9th overall in the index last year to 7th this year. The score slipped a little bit. And broadly speaking, so we'll talk to the Zambia specifics in a moment. Broadly speaking, we saw scores for countries this year for sort of one of 3 ways. One, just the inclusion of the ESG measures, right? Many countries scored either the minimum or barely above the minimum in that space, and so of course that brought down their average score. But I feel confident that that part of the index will see better scoring going forward as more and more countries place more focus on tapping these pools of ESG, local and global capital. The second bit is we made some changes in methodology. Some are really easy. We used to pull some data from the World Bank's Ease of Doing Business survey. You may or may not know that that survey itself has been pulled and doesn't look likely to relaunch. And so we've dropped those parts of the index for the time being. But in some others, we've changed data sources. We've queried the information a little bit more thoroughly. And so there's been some changing of scores just because of that methodological change. And then the third reason is, quite frankly, for some countries, the situation got less favorable this year than last year. We see that in some of the pillars where we look to measure market liquidity or turnover or depth. And it's not surprising in this pandemic environment that some of those measures have gone in the wrong direction. That said, and despite all those challenges, right, there are 4 countries did manage to increase their score this year, two of which, Ghana and Uganda, took this advantage and rose into the top 5 for the very first time for the index. And a much smaller country, much earlier in its financial market developments, I think also deserves special mention. Malawi moved from 18th place last year to 10th place this year, which just shows that even in difficult circumstances, a focus in finding ways to make your financial markets more open and transparent and accessible can really be very rewarding. But with that lengthy introduction fresh in your memory, let me hand you over to Absa Zambia's Head of Global Markets, Stanley, to talk you through the details of each pillar in Zambia's position in it. Thank you.
All right, thank you very much, Jeff, for that elaborate introduction and presentation to the first part. So I'll now take us through the second part of the presentation and bring it very close to home before we get into that very nice and engaging discussion here at the panel. So we will look at each and every one of the pillars and see how the scoring that Zambia has fits into basically what would have been prevailing on the ground, which I sincerely hope it comes out in that way. And then we will take it forward from there. So I will start with the first pillar being market depth. So with regard to market depth, if we look at the overall score for Zambia, Zambia came down 3 places compared to the last survey. And the score for Zambia came down by 4 points. So what we'll note is as we move through the pillars, yes, overall Zambia scored 7 out of the 23 countries, an improvement of 2 from the previous 9. But as we look at the individual pillars, we will see some of the pillars where we improved and some of them where we did not do as well and pretty much went lower. So in market depth, what attributed to Zambia coming down 3 places and the score coming down by 4? So a couple of factors in there. This is not going to be an exhaustive list of factors, but that's some of the things that were prevailing on the ground. So if we look at the issue of demand for our bonds here in Zambia, we'll note that around June this year, there seems to be an upswing in demand for our securities. So that led to an increase in turnover. If we go back a year ago, that wasn't the same situation. And indeed, a big part of the participants in the bonds that we saw were offshore investors. But there were also some onshore investors who went in there. And to see that level, that scale of offshore investors participating in our bonds, it added to the turnover, and that was a positive for the overall score in market depth that we have. Alongside this increased demand for bonds was the factor of positive sentiments. Sometime before election time, at least between June running up to elections, we saw some optimism coming back into the market, and it was on the back of that optimism, coupled with the higher yielding securities. By sub-Saharan African standards, if we go back to June, our securities were yielding a very good return, which was very attractive to a lot of investors, and that contributed to part of the positive score. On some of the issues in this particular case of market depth, that led to Zambia, took away some marks from ourselves, was basically the issue of product diversification. We didn't really do well in this area of trying to really diversify products within the entire financial market system. And further to that as well was the issue of primary dealership, which I'm sure we will discuss at some point. But not being a primary dealer system, it took away some points. There are some countries like Uganda that were able to successfully push through a primary dealership system. Same thing happening in Botswana. And because of that, that would have worked favorably in terms of this particular score. So that really speaks to market depth and the positioning that Zambia has. So if we can move on to the next pillar. The next pillar is access to foreign exchange, and it's quite an interesting one. So with regards access to foreign exchange, Zambia dropped 3 places just like we did in market depth, and our score came down by about 10 points. So again, there were some positives and some negatives, which talk to the score that we basically had. One of the biggest positives that comes out is the reporting of an official exchange rate. So Zambia is one of the countries where the reporting of the exchange rate is become so entrenched as business as usual that at any given point in time, we are expecting to see that, and we are seeing that. And I think kudos goes to the central bank for ensuring that that is enforced. So that gave us some positive points. On the other side is the issue of the adoption of the foreign exchange global code. So Zambia hasn't yet adopted that. It's a standard that governs, the FX deals and markets, but it's just a global code, which doesn't take away from any local guidelines. And it's an international one. So it's been adopted by a number of countries worldwide. So there is a hope that Zambia can also sign up and adopt some of those guidelines in there. And it's quite comprehensive because it will touch on all areas of the financial markets. So that was one item which would have been a positive if we had adopted. The other one is turnover. And I believe that's an interesting one because there were times during this year when there were issues to do with supply of foreign exchange. Many clients, would go from bank to bank trying to look for dollars, and there was this, belief that there is a shortage of dollars in the market. So primarily coming from that type of turnover and liquidity, we have some negative scores coming in here. And then speaking about liquidity again, and which may form part of the conversation we will have, it's also to look at the mining flows. So there's the issue of the mining flows, the statutory flows being removed from the open market and going to the central bank. So in as far as that affected the market liquidity, it also took away some points from our score, and that's on the negative side. But otherwise, overall, Zambia came down 3 places in the score. Moving on to the next pillar, pillar number 3, this is market transparency, tax, and the regulatory environment. In this one, I'm glad to say that Zambia moved up 1 place. And despite moving up 1 place, we dropped about 6 points as a country. So what really affected this? I'll just speak to 2 of the issues in there. And basically, the first one being the sovereign ratings. So the sovereign and corporate ratings that Zambia lost. I think we did have some downgrades there from all the 3 major rating agencies. So because of that, that in itself was a big negative for the country. However, there are some changes that we've started to see now. And with these changes, we can hope that when we look at the index for next year, it may come out as positive. And then also, one of the other big positives is the publishing of guidelines on green bonds. Green bonds or eco-friendly, sustainable investments or assets are a very hot topic at the moment. And the fact that the country has published guidelines around this, it worked very, very favorably for the country. And this is what put us in this position. It actually weighed in getting us up 1 place in terms of our overall score. So I'll very quickly go through the last set of pillars. Number 4 being the capacity of local investors. Now, the capacity of local investors is always one that is, it's usually quite debated at length, and some people tend to agree with it, some people tend not to agree with it. That's really the capacity of local investors. Interestingly, Zambia went up 8 places, so that's quite a good achievement in having risen that significantly. And in terms of points, the country went up by 6 points. So what are one or two things that affected this particular one? Interestingly, the sovereign bond activity that started to happen in June again, it comes back into this particular issue because it saw participation from investors. While this pillar deals with local investors and the capacity thereof, the fact that we had a lot of activity, they are quite significant, even from local investors. That's what led to this score going upwards. With that having been said, I must still mention that pension assets per capita for Zambia still remain at less than $100. Okay, just as for note. So the second last pillar that I will speak to is macroeconomic activity, which is another broad area. So in this one, Zambia remained flat in terms of positioning, and the score also remained flat. So we didn't really change. But this one was quite interesting in the sense that in the macro space, there were so many things that basically happened, right? Now, with us remaining flat, Zambia was actually second last in terms of all the countries, the 23 countries. Zambia was second last, last was Angola. So indicating that it's also an area which needs quite a bit of work in order for us to rise up there. Some of the factors that went into us remaining at this lower position are the debt profile for the country, which did not improve. Some of the fiscal challenges and the concerns around debt sustainability and some of the fragile economic fundamentals, especially also with the wake of COVID, which we can't run away from, and it affected the country in itself. And then also the credit quality for Zambia deteriorated, including an increase in the non-performing loan ratios. So these are some of the factors that led to the positioning for Zambia to have remained flat and second last in the pack of 23. The last one, which I won't really go into that much detail, is really the enforceability of standard master agreements. Now, in this particular case, Zambia came down one place and our score came down by 3. So some of the things that are being worked on, even by the central bank, is on the documentation, trying to get that to be widely used within the economy, and some of the factors around ISDA and also netting, the netting agreements. Those are things that are still very much in discussions, and we're yet to see some development coming through from there. And as it comes through, we'll then start to see the change in these particular scores. So with these few remarks regarding the presentation, I will end here, and I'll hand back to Motisunge, our moderator, so that we can proceed to the next part. Thank you.
Thank you very much, Stanley. Thank you very much, Jeff. I'm picking a lot of issues in 2021. Clearly, the pandemic brought its fair share of issues, but at the same time, I'm picking financial market development, which remains very key. Excited about climate stress testing, ESG issues. So getting into the exciting panel discussion that I did promise our viewers, I'm a very gender sensitive moderator, so I'll start by introducing Ms. Mutumboi, who's the Director of Market Supervision at the Securities and Exchange Commission. Welcome. All right, now that I've paid my dues, to my far right, I have the President of the Capital Markets Association, Mr. Nicolas Cavasso. Welcome.
Thank you very much.
And next to him, we have a seasoned tax expert. He's a partner at Ernst & Young. When you mention tax, Mr. Mawire's name always comes up. Mr. Patrick Mawire, welcome.
Thank you.
And we have from the Central Bank, the Director of Financial Markets himself. I have been itching to have a conversation with this man. Mr. Isaac, welcome.
Thank you very much.
And next to Mr. Ohanga is a renowned economist. He's very passionate about this country. Professor Oliver Sasa. He's the managing partner of Premier Consult. Welcome, Professor.
Thank you.
And next to me is Africa's finest. I already introduced you. That's the Absa Head of Global Markets. That's going to be today.
Thank you.
All right. So before we get into the actual pillars, I'd like to give Professor Oliver Sasa an opportunity to give his views on the index itself. I mean, do you think that it's covering all the pillars? What are your views?
Well, thank you very much for having me. And when I looked at the pillars, I was convinced that almost everything is picked. If you really want us to, by way of measuring, has to pick all the economic fundamentals that would influence in terms of attraction to a given territory, given investment destination countries that would encourage an investor to move in. I think it's very clear to me that not only have we picked everything that mattered, but perhaps my only concern is that this report, in terms of the information that comes, and especially to the extent that it compares countries, is not reaching out to the level that one would have expected. Because I think the information that has emerged really speaks more directly to what the policymakers need to look at. And more importantly, I think, when you are comparing your performance, in this case Zambia, you begin to feel that you are in a competitive spirit and you have to perhaps perform better than those that sometimes you believe are underperforming, but then you discover you are not doing as well. So the comparative aspect becomes important. The only thing that I was wondering, and I think I would like to hear views, especially from those that are more directly involved in the financial markets, is the absence of, as a pillar of political risk. In a more visible manner, I could see it sprinkled around a number of these pillars. But it's very important that the policy environment, which is very much a factor of governance, does really explain how attractive a given economy is. A mere shift in political governance, what happened in August in this country, does loosen up a number of these fundamentals that we've been looking at. To the extent that you end up having a certain level of comfort, especially with respect to policy predictability, policy consistency, and the ability of the economic players to feel a certain level of comfort at the level of, if this is the policy regime, and if it's consistent for the next 5-10 years, we should be able as investors to move in and invest with that assumption in mind that we can predict how it will look like. I would want to see this as a pillar considered, because I believe that, especially in the context of Africa, governance is fundamental because it tells you more directly how policy is made and whether it's hospitable enough to encourage investment. Perhaps we'll talk about this a little bit later at the right time.
Thank you, Professor. I think one key takeaway is that governance is very, very key in this. So moving on to access to foreign exchange, I think that's a pillar that is relatable to most practitioners, especially related to foreign exchange. But before I get into this, I would like to have an idea of how trading was in COVID era, and that's directed to Stanley. How was it COVID era to now?
Okay, thank you very much. It was quite interesting and exciting at the same time to firstly work on the belief that a conventional dealing or trading environment requires people to be in the office 100%, including most of the rules that govern what we do. They require us to be authorized to deal from one or a designated physical location, having to move away and work from home because of the COVID environment was something that was quite interesting. It was quite, listen, there were some challenges in the initial part, right across the market in itself, but it's something that we adapted to. So to say, we need to be able to adapt. The pandemic, which came without warning, and eventually it affected us to that extent, where we now are working from home, but are still expected to be able to trade on that information with that coordination, despite sitting in different locations. So that was the first part about it being exciting. The second part is really, in Zambia, we've had our fair share of challenges, especially on the fiscal side. And that speaks very squarely into our trading activities. So as I mentioned earlier, we had situations where there was less foreign exchange on the market than the demand in itself. There was actual demand that had grown from some of the productive sector. So there were moments when we had certain shortages, and it became quite challenging. At that time, we had to become much closer friends with Big Brother Central Bank. We were always in constant dialogue with regards to how we could, kind of help the market, how we could make the flow smoother and to allow and enable trade to take place. Because if we were not trading, then you can imagine that the productive sector is also going to have challenges. If they have access to foreign exchange, which they need, they will not be able to import. They will not be able to settle on their letters of credit. So it was so many things happening at the same time. And while to have an election coming through as well, it was a very, very mixed bag. But there were times when it was positive, times when it was negative, times when it was extremely stressful. But yes, we've sailed through, and here we are now.
Thank you very much, Stanley. And the next question is channeled to Mr. Mohan. I'm sure after Stanley has spoken, I also want to know how it was being the regulator at such a time. But before you answer that question, I'm looking at the score. 50 out of 100 coming from highs of about 75. I think the first time that this index was launched, access to foreign exchange, especially that floating exchange rate regime. And then a number of factors that we see last year, from asset sales pressure. I think at some point there was an initiative asking the mines to dollarize royalties, but then the argument there by a number of practitioners is that it struck the FX market. So I'd like to have a view from the regulator on that, and are we likely to see a shift in policy to bring back activity to the FX markets?
Interesting observation. Conducting public policy under an environment of COVID was very, very challenging. It still is. I mean, the adverse effects of COVID are still evolving. A lot of them are still very uncertain. And so all our public policy decisions are a function of that. But on top of that, there is need on a continuous basis to preserve financial system stability. The importance of the financial system cannot be underestimated, and I think we know that besides all the economic activities, you see there is a financial system behind the scenes. So this financial system needs to be preserved under whatever conditions, whether under conditions of stress, even under war. You still need to continue to have a financial system that is firing at least on all cylinders. So having said that, let me just go back a little bit on the issue of the FX and what motivated this change in policy. Contrary to what many believe, that by dollarizing taxes, like I say, it took away liquidity from the market. What we actually do is that whatever we receive as minimum royalty tax remittances are sold back to the market. So if you receive $100 from mine X, it's immediately sold back to the market. So what has changed is just a mere channel through which the banks themselves were getting business. Before that, they would get it directly from them. Now they no longer. They have to get it through the central bank. So what is the net effect? It's zero. So as far as the numbers are concerned, the same amount of FX that was taken away is still taken back.
That is important. Why is that important? Because it is the tool that is utilized to ensure that the market itself remains resilient. Because the hat we wear as public policy makers ourselves is not a biased one. We have to look at the whole economy, okay? Unlike the private sector, because private sector's objectives are not social objectives per se. They are there to make profits. And anyway, they are made to do that. Public policy, in our case, the central bank, the government, there are human beings behind every public policy. So when you make that assessment, that how we are moving from here, we are likely going to go into the teach. You make certain decisions. Some decisions may not work well for some private sector areas because maybe that's how they will survive. But on a broader scale, you are looking at public risk. Okay, and so what decisions do you take? It's pretty much like the Minister of Finance who increases taxes. Increasing taxes is never a popular thing, but he understands why he's increasing. Okay, so analysts will go around and condemn, or but usually such kind of analysis is not complete until you hear the motivation behind any particular decision that is taken. So I just wanted to make sure that that issue is very clear. Now, are we going to change? I don't get any signs that there is any appetite to change. Okay, because we are not out of the woods yet. And so, to answer your question, this is something that probably will be with us for a little bit of time. What else would I want to say here? I think that is probably the best that I can say around this. And I think that Stanley did bring out that this interaction, it increased because it was one of the strategies to ensure that the financial system itself is resilient even under very trying and hard economic conditions that we are still in. As you know, the macroeconomic environment is not very good, and so the financial system needs to be made sure that as the economy picks up, it is right there to ensure that everything else goes on very well. So I think that's what I can say about this issue of mining taxes.
Thank you so much. I'll come back to you, Professor. Question next asked to you. So clearly, Director has told us that we're not yet out of the woods, and I think the woods there refers to the fiscal vulnerabilities that Zambia is facing. What's your comment on fiscal posture going forward in relation to what we should see in the markets?
Definitely, we are not as yet out of the woods. If you look at last year, GDP growth was minus. The figure that we got in the national budget for 2022 that was announced last week, it was minus 2.8 GDP growth. That's a regression, and I've seen figures with the World Bank giving a slightly worse scenario at that level. Almost all the macroeconomic fundamentals that we expect to show positivity, we saw decline. But I think the elephant in the room we all have to accept, and which has led to challenges, which we are now talking about bringing in the IMF program to support. The effort is really debt, sovereign debt, and that to a large measure this has stifled significantly growth prospects, and it has to be managed. At the moment, we are somewhere in the region of 14.7 sovereign debt external, and if you push this, especially if you look at the domestic debt and the arrears, if you combine those, you are really talking about a very very unhealthy situation, which of course ultimately has not really brought the level of support for growth of enterprise growth, industry growth, investment growth. We've seen this, and we haven't enjoyed the significant sort of positivity with respect to credit rating. We are still very much in the junk category, and we need to upscale at those levels, because most of the parameters that are used to determine our credit rating are not very positive. I think the most positive thing that has happened in terms of going forward and opening up the market, and including the area issue that I touched upon in terms of the politics and the governance issues, is actually the change of government. It opens opportunities of hope. I'm still emphasizing hope, because almost everything will be dependent on how the performance will span out. A number of things suggest that there may be a certain level of stability if one has to look at the 2022 budget. So to some extent, there is hope, and my take is that for the 2022 index, we are going to see Zambia perhaps performing a little bit better than what I've seen in terms of the figure that has just been summarized to us.
Thank you, Professor. Mutumboy, next question is for you. From 23 kwacha a dollar to 20 to 19 to 15.85, back up to 17.22. How has currency volatility been for stock market performance?
Thank you very much. And maybe just to express my gratitude for this fifth edition of the index. And before I come to your question, I really wanted to pick it up from what we discussed so far. Capital markets. On our part, it has been a very tough time for the market, and I think in terms of how we performed as markets, we sort of had our own challenges even before we saw the onset of COVID. By the time COVID was at its manifestation in this market, I think we saw most of our counters falling in terms of pricing. The exchange rate for us is a big factor in terms of how the market performs. We are a very small market that is dependent on attracting external capital. And when you have volatility of exchange rates, it becomes very difficult to get the participation of investors from outside the country. And you could see that with that volatility, what you saw was a lot of foreign participants exiting the market. What you also see when currency, even locally here, is your local participants also begin to prepare to hedge themselves in securities that secure the value of their investment. So our current capital market doesn't quite sit very well in terms of securities where they hedge themselves in that sense. And so you see that the capital markets again, even from the local perspective, is abandoned. So we did shrink, and with this positive sentiment, what we are seeing is there's more activity now in the market. We're also seeing the businesses themselves having better capacity in terms of imports, the backdrop of a better currency, where the cost of doing business is also reduced. We can see that begin to factor in the valuations of those businesses from that sense.
Okay, thank you very much. Before we move on to the next pillar, maybe for Director is clearly there is volatility that has been seen in this market, but is the central bank doing enough to ensure that there's a balance? You see, there's exporters and there's importers, and there's been a general outcry that the swings were too steep. Comments?
You see, swings in exchange rates are a normal phenomenon because they are driven by demand and supply. the central bank, especially in this part of the world, she was talking about hedging, is the effective hedge for everybody. When importers want to import all sorts of things, ranging from matches to machinery, they expect that the central bank still needs to come and protect the rate at which importers operate. Similarly, exporters have the same kind of or similar expectations. Now, as should a central bank be concerned about one group of people over the other? The answer is no. The best you can do is provide an environment under which exporters and importers themselves are interacting. They are swapping those liquidity, those buckets or kinds of monies that they are generating. They are swapping the monies themselves through the financial intermediaries. And for us, we have to maintain a stable environment under which both of them, operating independently, achieve their own sorts of objectives. So I'm sure importers were very happy when they were seeing the rate come down because it was cheaper for them. Exporters were not very happy. And I think if you follow news very well, you saw how some traders in Kasumbalesa border were very unhappy when they saw that the exchange rate was appreciated. They called us names because they thought the central bank is not doing a good job. I watched that debate on social media, but others were praising that, well, this is a good thing and everything, because they were looking at it from their own perspective. So why am I bringing this? Because why we do what we do is that we don't really wear a hat of one group over the other. The best we can do is to deliver an environment under which any business person can operate. So, and I was earlier putting an emphasis, I think, on the matter of preserving financial stability. Because banks, left on their own, are generally pro-cyclical. Okay? What I mean by being pro-cyclical is that when the economy is in downturn, banks will tend not to lend. They want to preserve their liquidity because their shareholders are worried about losses. They are worried about other things. We are not. That's not our area of worry. So what we would want is that banks should still continue to operate even under those environments. In fact, they need to be counter-cyclical so that you see when the economy is going down, they provide the liquidity that the economy needs. And it is not the job of the central bank, so to speak, to operate in the manner in which you have explained that what are you doing about it? It depends on who's asking. Obviously, if you're an importer, I know that when you ask me that question and say, what are you doing about it? I would first want to ask you from what perspective. Okay, if you're an exporter, you're also going to ask me. So I've gone around this, and I hope that I've said something sensible. But the bottom line is that providing an enabling environment under which both groups operate and thrive is what our primary concern is supposed to be, unlike any other public policy.
Thank you very much. Just we move on to the next.
And maybe before we leave that part, I just wanted to, what she had talked about hedging, which caught my mind, and what Professor was talking about. You see, delivery of macro stability also is critical in all these numbers that we are looking at here. We've fallen here, and I'm looking, and in my mind, I'm thinking that, look, if underlying all this is macroeconomic stability, okay, why are interest rates high? It reflects something fundamentally wrong. Okay, if you are, the central government is always in the market, or interest rates will increase. Now, if you are an exporter or an importer, how do you hedge yourselves against exchange rate risk in such an environment? How do you price? If I go to Stanley and say, look, can I buy a forward contract from you? The price is very prohibitive because the interest rates are very high. So delivery of macro stability will ensure that interest rates are lower. Importers like the ones you were talking about and exporters will be able to gauge appropriately. And so the central bank's job will obviously be known that they are not in that area.
All right. Thank you so much for that elaborate explanation. We move on to market depth. So with market depth, I think it's very clear that there's been a lot of developments across Africa, and Zambia inclusive, but the score there is still low. That's 37 out of 100. That's for Zambia. So the next question will be for the SEC, Capital Markets Association, and the Central Bank again. I'll be coming back looking on the Joseph. So I know that there's a lot of developments that have happened. There's sandboxes, the regulatory environment, and there's one topic that I think you're very passionate about, the green bond era, ESG being embedded in the financial markets and all. So, and most recently there was this the usage of technology to enable purchasing of stocks on the stock exchange. I think now people can use mobile money. That team signed with MTN. So just to get your views on what other initiatives that are you looking at to deepen capital markets as well, and then you can also make mention of the green bond initiatives that you've been working on.
No, thank you, Mr. Sonia, on that. And I did want to make a comment earlier that when you get a result or an outcome that you don't like the 37, you need to introspect and ask serious questions as to why that is. And I think as a country, basically, it's doing a lot of that this year, following the outcome of things on the political scene. It's been a lot of introspection at individual level, institutional level, and I think at the national level, we're having to ask ourselves why certain results the way they're figured and what it is really that we want to see. So for me, I really want us to actually tap back into the person that the top or the issue that you raised. And if you recall last year, I left the meeting saying that we were at a point in our economy when we need crisis managers to take us out of the situation that the country finds itself in. I don't think we are out of the woods, as Isaac mentioned. We're still in that position, and we're still needing this sort of skill set of people that are literally introspective and really brainstorming to ask deep questions, deep-seated questions. The results of what we see is because of the systems that we are seated. The systems that we're seated with are because of the governance that we have, the individuals that are driving the policies, the technocrats in our seats, some of us here. So the 37, to change the 37, it has to start now. We need to ask ourselves a fundamental question: what is it that we want to see? How are we going to achieve what we want to see? And we want to see ourselves move from 37. But it's a very deep question in the sense that we ought to be starting from asking ourselves what our vision is. What is the vision of the capital market that we want to see? When we talk about market depth, when we talk about product diversity, what is the vision that Zambia has from that perspective? This process is ongoing as far as we as a regulator and the association is concerned. We already have drafted a capital market master plan that is speaking to this vision that we have agreed as a key stakeholder of the capital market. And basically what we are saying in the master plan that is in fact currently sitting with the Ministry of Finance for the final processes, got a call, just them confirming that it's going all the way through to cabinet for approvals, which is a good thing. The vision that is stipulated in there is basically addressing that statistic, where we are saying to ourselves, perhaps the reason we are not seeing more products is the way we are treated in terms of the electric framework that we spoke about. It might be we are too fixated in traditional ways of doing things. And so we have a document that is attending to some of the issues that have made it possible in the past for us to create these new products. So from where we sit, you mentioned very clearly that we have put in place a framework for green bonds now, which puts us in very good stead as a country, because right now there is nothing that stops the bank, for example, from issuing a green bond, because we have the Apex regulation. You spoke about, and in fact, just to mention that as a market now, we find ourselves in a very good state in terms of the direction that the current New Dawn government has. The New Dawn government has emphasized 4 areas of interest. Green economy and leader capital markets, and my colleague who confirmed that, were very, very entrenched in pushing the agenda of green bonds. We're going around to identify the blue issuers. The next thing that you heard from the New Dawn, digitization and the leveraging of technology in the way we do business, so that we can have financial inclusion, trade products on the platforms. We talked about the listed and the MCN relationship. In the capital markets, we've created a framework that is regulatory standard. And right now we have 4 game-changing innovations in our handbook. And those innovations speak to products that we think are more customer-centric, as opposed to just adopting this capital markets model of developed countries, where the focus is just on the stock market. It has shown us, we've had capital markets for over 20 years, and we can see that perhaps what we need is a multiple model that's not just focusing on this blue chip platform. And so with the innovations that are in the sandbox, you will now be seeing peer-to-peer lending platforms coming on board. You see crowdfunding coming on board, and many other digital type of innovations within the capital markets. That's beginning to give us more assets. The third thing that we also see from the New Dawn in terms of really emphasizing is the small and medium entities. So the Zambian capital market originally was developed on a state-of-the-art legislation framework, copied from the US some 25 years ago. It hasn't quite worked. And these new innovations that we're talking about, we think they will be more inclusive, and we can now begin to see SMEs come to a crowdfunding platform and access money using the capital market. So we're also making the capital markets relevant so that we can use these products which are more customer-centric. The final one that I think I've picked up from the New Dawn in terms of emphasis is the governance, which is also what Prof raised from the word-go. And he realized that he's not seeing that being a pillar that's been assessed. And I want to agree that it's extremely, extremely important. And for us within the capital markets, how we address it is we have decided that we need to have a common vision that we're going to document, and this is the capital markets master plan, is a 10-year document, a 10-year roadmap. So what we see with that is it's easier to have direction, it's easier to have purpose when you document a vision and put a plan and strategy of how you're going to pursue that. Even when you have a change in government, for example, if this is an agreed vision, it becomes very difficult to shift that. The challenge I've seen with us is we tend to carry on without purpose so much, without shared goals, and then it's just doing things ad hoc as and when they come. So this is the first plan the capital market is putting in place, and we are extremely hopeful that it will direct us as stakeholders in terms of realizing some of the things that are in that document, including the product range that we want to see in this market.
Thanks, Mr. Absa.
Yeah,
Okay. Sorry. Sorry, I interjected. I have a slightly different question for you. you could, add on to what she said. But I'm thinking to myself, 0 IPOs, entirely, very little trading activity. You look at volumes compared to GDP. Another topical issue is, I think we've observed that there's been a number of players that either delay financials. It's expected that if you're listed on the exchange, you should have the financials circulated. So delays, or some entities are not even providing those securities. Do you not think that those are some of the issues that actually affect the attractiveness of stocks as well, in addition to the risk landscape of money?
Yeah, I mean, those are very good pointers, and to what I've said, some of those are governance issues that can actually give you a better barometer in terms of how the market is performing, and whether me as an individual investor can take my money where maybe some of those governance laws are there. So yeah, to some extent, yeah, those are some of the the glaring issues we may be able to pick out in the market in terms of just why it's underperforming and things like that. But I think other than that, I think they are very structural, bigger challenges than probably just submitting the returns, in terms of financials, look at the way the market has performed. I mean, last year when we had the second conversation, I did mention an aspect of trying to attract the retail market onto the market. And I think I did commit that we have been able to roll out the mobile platform by the first quarter of the year, this year, and that was actually part of the managed to roll out the platform. More than just us having platforms, it becomes an issue of chicken and egg. Which one came first? Do we need to get the products on the market, or do we need to increase the participation first? Because those are some of the inherent challenges we have. Do we need to get to drive the participation before we can be very aggressive around the platforms, or should we do the other way around? So we have a platform now that, in as much as it does what all those enablers, you can be able to do your purchase of stocks and bonds via mobile money, Airtel money, mention it. But the issue that is there now is that in its right form in terms of attracting the requisite retail market to the capital. So that's another discussion probably can take up for some other day. And then if you have to look also at what the report has also reviewed, just trying to help us get to see what we found. I was interested and very intrigued to see what Seychelles is doing. Once again, it was a highlight in the report. Last year, it had 22 listings in 1 year, we did 0. And this time around, I think it's in the news again in the report, where they have actually automated in terms of their listing procedures. So from the comfort of my office, I'm able to get my company listed on the exchange. Again, these are very spectacular sort of innovations that we should be able to look at. And I think, like I said earlier, we need to be able to kind of delve into the issues. Are we lacking platforms, or are we lacking support? So in terms of having participation, I think that's one huge area we don't seem to have from the Zambian perspective. If you just look at the comparative of market cap to GDP, the report is very explicit, 14% in terms of market cap to GDP. Seychelles, a very small island, they're doing 1.9% of GDP. Already that just shows you where the dynamics are, not working out for us as a country. So we've got structural inherent challenges why the market is not growing. First and foremost, it's us as individuals. We're not being so forthright in participating in the market. And I think that has got a very huge bearing in terms of how much growth we can be looking at in terms of our listings every time. Because if you look at the current trends, if you're going to come to the market today and you want to list yourself, chances are that you're going to have 3 or 2 maybe large pension funds listing into your the reports that you're getting on the market. So we're at the other rate of participants. So the confidence has to be driven from just a bit of rate, but we have to have very deliberate, sort of plans. And I think coming back to the points that the professor had highlighted, with respect to even policymakers, if we are also going to gap with respect to understanding around the policymakers, we want to have these inherent challenges. Mauritius is in the report telling us that they've done tax incentives, for issued companies on the exchange. Those are some of these few initiatives we can think around. Can we then be able to get concessions for those who are going to list? For those of these things are going for debt, and equity is very cheap. So if we drive the volume of equity of SMEs to every market, we might as well be answering the long call of how can we bring down the cost of funding for our SMEs.
Thanks. And leveraging of tax incentives, Mr. Mawiri, tax incentives. Do you think that we could use tax as a country to stimulate participation of SMEs in the exchange?
I'm always pessimistic about tax incentives because tax incentives as a policy driver are very poor in most instances because the tax decision generally is
the last decision that somebody that's going to invest will make. So if you look at, for example, our system, our hearing different people talking about, diversifying the product and so on, depending. If you look at our Income Tax Act, it has two sections that deal with financial instruments. One deals with interest, the other one deals with foreign exchange gains and losses. That's it. So our tax has not moved with the product, and I think for the people on the market side, it must be frustrating because if I come to the market and say I've got a derivative, then you get into the debate whether I come back and say no, it's separate source, but I'll get into behind again and so on. So there are all those challenges. If you come and say, okay, I want to float a deep discounted bond, for example, our act doesn't even have a definition of interest. So there are all these challenges that we need to revisit the tax system. I think just simply putting an incentive doesn't really provide the answer. So we have an incentive already, for example, on shares, which are traded, but that has also evolved along the way into an avoidance instrument when it was meant to be an incentive. So now we have a two-tier system. If I'm a company that has issued 50% of my shares are trading on Bose, the other 50 are sitting somewhere. The 50% that are trading now have a tax-free incentive. The other one, now there's a debate, okay, should they be in a depository for them to qualify? If I'm just holding them in my share treasury, they don't qualify. So it's those kinds of difficulties where we have incentives, then we go back into avoidance without really going. If you want to give an incentive, give an incentive. Don't fall back because the incentive is working. Incentives work, but somehow when the system kicks back, there's an immunity to incentives working. The moment incentives start working, that immunity kicks in and we start tinkering with them. So I think there are other things that need to be addressed before we start talking incentives.
Thank you, Mr. Mawere. Back to Mr. Mohammed. Absa in Kenya. My colleagues are able to buy bonds in the company of their mobile phones. I know there's been talk around introducing that in Zambia, but I think I just heard about it was 2 years ago. Are we being agile enough with digital innovation in the space of government securities? Or when should we expect to be at that level to be able to allow the retail pools as well to tap into the government securities market?
Yeah, I think this is something that is we are working on ourselves. Admittedly, maybe we moved a little bit slower than what we should, than what we would have liked to be, but it is something that we are working on, as well as leveraging on so many other technologies that are coming, sandboxes and stuff like that. These, I think, are game changers. I think everybody else, manual as well as outside there, realizes that technology is the way to go if you have to make strides into any aspect of economic activity. So from us at the Civic Bank, that's something that we are keenly looking at because we have this passion for financial inclusion, and we think that that's one way in which we can bring people up. And people learn, obviously, as they trade. You see, some of these things, they look very simple to us who understand them, but to other people, just a small thing like interest, that very word interest can be very confusing. So, so I believe myself personally that the more people use these products, the more they become knowledgeable, and so through that platform again we deliver financial inclusion, and broadly the whole market.
Thanks, Mr. Muhanga. Back to Mr. Mawere. Market transparency, tax, and the regulatory environment. I see Zambia did score quite good, 69 out of 100 compared to the likes of SA at 84, Mauritius 83, and Zimbabwe in the top bracket. Seems like we're doing so well in that area. So there's been all these developments around environmental, social, governance, and allow me to deviate a little bit. Leveraging off Professor's statement around good governance, because it looks like from good governance, then you can have the right tax policies and eventually all that. Do you see ESG considerations ultimately affecting the tax environment and how exactly?
So I think that's interesting. Maybe out of interest, when I read the report, the score was somehow impacted by some 10 treaties that were signed. I'm looking for those 10 treaties. I'm not sure where they are, because certainly I have no clue which 10 treaties we are talking about. But the report indicates that inflated the score. So I'm not sure. Because on the record, actually, we did pull out of a treaty last year, which is Mauritius. And we really, in the year under the review for the report, I doubt that we ratified it. It's been an absolute freeze on treaty ratification. Coming to ESG, I think that, if you look at the agenda on ESG, so for example, I think Brussels did run corporate governance and sustainability reporting awards. Unfortunately, the agenda again, hasn't really been driven. It's a fringe agenda. It's not in the mainstream. So even if you look at the tax system, for example, there's very little incentive for an ESG agenda for a corporate. So if I set up a fund and I start putting money aside, for example, for environmental restoration, there's all sorts of debates as to how that should be treated. That's number one. Number two, if you look at the way we treat our, one of the things that we've been looking at, for example, recently, is carbon credits. To get that defined, even for VAT purposes, has been a battle. And that's all part of the ESG agenda. Why can't we have an active trading, carbon credit market? We have a lot to offer. There are people who come and plant 1,000 trees and trade off the carbon credit. People want to do that. But getting the tax framework to work and support that is a challenge. So, I'm always interested when I hear regulators and so on talking about these things, and I'm thinking, okay, are you pulling the ZRA and Minister of Finance policymakers along? Or are you having a conversation? When that's signed and sealed, then one day someone will wake up and say, oh my goodness, we forgot the tax, and then it's a mess. And this is what has happened in the past so many times.
Thank you, sir. Professor, I'd be shocked if you don't want to comment on carbon credit.
Well, if one just looks at what's happening globally at the moment and what's happening globally, I think the world has recognized the value of moving in that direction. And the capital markets have played their role at that level. And I think it only makes common sense that everybody has a contribution if we have to make not only the business environment, but the global environment generally positive at that level.
So thanks for that, Professor. The next question is Stan, macroeconomic opportunity. In fact, what Stan and you, Professor, Zambia didn't do so well. Of the 23 countries, Zambia was at 22. And cited was fiscal management issues. And governance, for instance, we are back to governance. Maybe for Stan, what is your ideal type of environment that will support the trading desks and drive that requisite contribution that Absa is making in this market?
Okay, so that's an interesting question. And you see, where we like to operate is an environment where you can have as many participants as possible. And that ranges not just from your local or onshore participants, but also your offshore. And one of the things that are really advantageous here, because with a lot of our colleagues, especially in the more advanced markets who participate here, they really rely on information to to guide their trading or investment decisions. So any kind of information that comes out, and they are keen followers of what's happening in the fiscal space. So anything that comes out that sounds negative is almost a red flag for them to not participate. And once we have a fewer participants in the market, it then means even the activity, it starts to reduce. We've seen that before, some 2.5 years ago, that when the bond market had actually peaked, and then we saw offshore investors starting to pull out at the beginning of the fiscal issues, and at the same time, even one of the biggest players, which is local, the National Pension Scheme, also pulled out from the secondary market and went into the primary market. So then, just by the size of Absa and offshore investors, the secondary market, pretty much died. Okay, so for us, it's an environment where we have some form of stability. Yes, as traders, we like volatility because it then makes trading more exciting. But at the same time, at the broader level, at the broader macro level, we do like that type of stability. And at least if there's something assuring in terms of positive news, so that it can have as many participants as possible within the system. For us, that is the absolute most ideal, because then it allows us to be able to trade in whether it's different asset classes or different products. I must say it was very difficult. This year has been quite a difficult year to be able to do things such as derivatives, because there was a concern around liquidity of the same. So we had very little going out of the market. But if you have an environment where there is some surety around some of those factors, it makes it exciting, because you can go into many asset classes or many products.
Thanks, Stanley. And Mr. Mwanga, have you hold on to something? Primary dealership. Do you have any plans to relaunch primary dealership in government securities? But before you answer that question, let me finish with the professor. Professor, fiscal management and governance issues seem to have cost Zambians performance on this pillar, macroeconomic opportunity.
First, I think policy consistency and predictability is very important, because it allows the corporate to be able to plan and make corporate decisions based on assumptions of what is on the ground. I believe that it's even better to have a bad policy and consistent bad policy for a longer time, and I'm able to plan and go around those hurdles, and I can consistently say in the next 5 years it will still remain the way it is, than having a very good policy that keeps on changing when I'm about to score. And that is really the fundamental point where we had a problem. That sometimes you find that we were in the previous regime, it's like we had as many presidents as we had ministers. Each time a minister changes, the policy regime changes, and it's interpreted differently. Decisions that come from cabinet, sometimes you find that they are seen differently, and you see ministers quarreling and interpreting differently in the public domain. That is not good for business. And that itself is really one of the challenges that we actually want to appeal to the incoming government, now they're there. That you must be predictable and you must be consistent. Because it's ultimately at the end of the day, you'll be judged. And the decisions at the corporate level will be made based on what you say. And the consistency and the transparency with which you are saying it. For me, that is really fundamental also in the capital markets, because really you are products of the policy regime within which you are operating. And that to me is very, very fundamental.
Thank you, Professor. Mr. Mwanga, any plans to relaunch primary market dealership?
Yes, we still have those plans, although they are temporarily shelved. I think once the conditions or areas of concern have been dealt with, then we should be able, we should be good to go on this agenda of primary dealership. Let me point out this, that I know it's one of the metrics that has been used in this survey or to make an assessment. But you will understand that not all countries have primary dealership. and they are very successful in their financial markets or financial system. So having a primary dealership to be or not is not necessarily a measure of success. Some other countries use different systems altogether, and they are very, very successful in the way finance is used in that area. So maybe, I mean, that's the only issue I had about the absence or presence of primary dealership as a plus or minus. You know, I think what is important is whether, you know, the system that is present or that you want to bring out is able to generate the same kind of liquidity that you think a primary dealership system can do.
Thank you, Mr. Mhanga. Stanley, as a global market head, do you think that not having one right now is adversely impacting trading?
Well, I wouldn't say that it's adversely impacting trading because, as Mr. Mhanga has mentioned, there is a market and it currently operates and it's functional. There's both primary and secondary market. So things have continued, and there are reasons why, you know, the whole primary dealership was shelved in the first place. It was to do with certain concerns, especially around the fiscus. Yes, a primary dealership system coming in would definitely be a welcome move from you know, from the market, because it changes the dynamics within the market. It allows for, I think, an even greater reach, because then banks now have even more incentive to want to reach, whether it's the retail customers, reach every other sector, in order for them to be able to turn around the securities that they would have been allocated from the central bank. So it would be interesting for market development, but as Mr. Mhanga said, it isn't necessarily a bad thing to not have, because the system does function even without primary dealership system.
Thanks for that. So capacity of local investors is the next pillar we move to, and this question is for Ms. Futumboy. I see Zambia doing so well there, 18 out of 100. But if you compare jurisdictions like Namibia scored 100 out of 100, South Africa 77, and Nigeria 44, Kenya 24. So my question is, what is the biggest challenge? What is holding our institutional investors from effectively participating in this space?
Thank you, Mr. And it's really sad when you read statistics like that. And Namibia, which is a small country, how much better. It's a fundamental issue that I think Nicholas referred to. With the institutional investors, we usually go to scrutinizing the investment guidelines that they set in place. When you look at their current investment guidelines, they're very limited. So we should be scored in terms of can they participate in different assets that sit within the capital market. I think what needs to happen is very clear deliberate policy of how we make the institutional investor comfortable to participate in the capital market. What Namibia has done is they've put in place a very deliberate framework where you can create unlisted vehicles that are overseen by the regulator, the Absa. And basically what those unlisted vehicles do is they are entrusted to various fund managers. The equivalent of Absa is required to invest through those vehicles, unlisted vehicles that are supervised by the equivalent of SEC, and the mandate of those vehicles is to then invest in the businesses in Namibia. So basically what you see with that initiative is they have created a safe environment that gives the pension funds the confidence that money is being channeled to where it's supposed to be channeled in terms of driving the commerce of money. And that's why you see them scoring very nicely there. it's because they haven't allowed their pension fund to find an easier route where they're going to put money in government paper, which is what's happening in this market. And then just talking of that issue of where our pension funds prefer to put money in government paper as opposed to investing in Motisunga and Mboi holders, we need to address that as well. It's a policy issue. So the aspect of the government paper being so lucrative is a killer for the capital markets, because in essence what you're doing is you're crowding out the private sector, and you are saying, give me as a government as much money. And any day, the banks, your big investors, they would rather take this money to the government, who is a safer investment option, as opposed to giving it to an SME like you and I. So that issue of policy, these are the issues we put in the capital markets master plan. It's not an easy document. It's not one that has taken long to be finalized, because we basically put it out there for the policymaker, for the technocrats, to really ask themselves the critical issues. Because if you cannot be complaining that your capital market is small, that your pension funds don't come to market, and complain as if it's a rocket science issue. It's not a rocket science issue. It's an issue of where you ask yourselves what you want to see. And once you've answered what you want to see, the vision you want to see, you dedicate yourselves to putting in place the system and the governance that will bring the results that we want to see. So Namibia, beautiful example. They basically wanted to see the pension funds support commerce, support the SME. They put in a very simple structure, which we can cut and paste even today.
Thank you. Thank you very much. Mr. Kabaso, our level of Ms. Mundia's statement, where she said the lucrative nature of the bond market is what is killing the capital market. We've seen that curve come down significantly after the August pause. I think on the bond end, not about 800 basis points, and in the 1 year, about 1,200 basis points. Question is, does that excite you? Do you see capital markets resurrection, if I was to use that word?
Yeah, I mean, it goes without saying that that's not an opportunity for the capital markets to win. I mean, literally, we have had some allocation of capital out of capital markets going to fixed income markets. But obviously now the yields coming down on government securities, they will be able to see now an invasion of capital market equities. And because that's probably one opportunity where investors are just into yields, we're going to get to see some decent margins. So it's an exciting point of view for us, because now we get to see the redirection of capital, and even the private equity side also becomes more lucrative, because now they can easily benchmark in terms of what's the cost of capital in the market, and they can redirect capital to the right segments that can give them some decent margins. So we're happy with this.
Thank you very much. Back to Ms. Mundia. I have a question for you. It's a little controversial. As a regulatory body, what are you doing for entities that should have listed on the exchange but have not listed, and they keep on begging having to list? Do you not think that they are contributing to the stagnant number of listed entities, and also market depth and attractiveness of stock? So that you have
Thanks again. Very good question that you asked there. So you're right by asking what are we doing, because the SEC has a dual mandate to supervise the market and to promote market development. So in terms of what we're doing, is we have co-led, we have offered leadership together with the Ministry of Finance in terms of crafting the vision that I spoke to earlier. The Capital Markets Master Plan, and I will not stop talking about it, because it really has had gone round. It's got the views of so many of us, so many Zambians. It was done independently. It wasn't the SEC. We had consultants assist us to get the vision into this document from the financial sector in Africa of Kenya. This is the same consultant who has helped the Kenyan market to be the darling of capital markets in Africa, and an inspiration that we're looking at. Well, they have been here, and they've assisted us to put in place a document that has got the answers to those issues. So, again, vision, what do you want to see? And once you have defined that, what I want to see is my big institutions or my big businesses, the banks, the mining companies, the manufacturing companies. If the vision is we want to see Zambians participate in those markets, they will put in the policies and they enable the framework to do that. We had one policy which was very progressive in as far as dictating that certain companies come to market. In the telecoms, the MTNs of today, in the license condition, license from ZIPTA, there was a conditionality that after X number of years, they were required to come to market to list. That's one. The mining companies, the reason why they sit on the quoted tier is because at the point of privatization, there was the agreement to that effect that they needed to allow Zambians to participate in the mines, especially that mining is our core activity as a country. And that's why they're seated on the quoted tier to see that I am coming to this anytime soon. So it's simple. We will need to be very unapologetic about our policies. If you want to see Zambians investing in these businesses, and if the businesses are probably needing to be motivated, then there is an instrument you can use. It's policy. So you can have a policy where you encourage or mandate the businesses that you'd like to see participate in the stock market come on the stock market. Because the question is why would it not be in the best interest of even those businesses to come to market so that we participate in those markets? So I think capital markets market planning is a key one because it's unlocking this very uncomfortable discussion, but it's also forcing us to literally put a pen and begin to visualize what we want to do. There's always been a debate, by the way, as to whether we should be forcing companies to come to market or we should leave it as a business case. And I'm for one who believes that we should do both. So the practitioners should be out there giving their business sense as to why it makes sense for individuals, for institutional investors to participate in these businesses. And at the same time, we should still have government very alert, putting in place the right policies that they need to ensure that we're all participating in our resources.
Thanks, Mr. Mawiri. The non-tax deductibility of mineral royalties have been a very big headache for Zambia, and I'd like to tie that question to the access to foreign exchange. Now that your mineral royalties are tax deductible, do you see an increase in flows? And why I ask that question is because the next question will come. Then you say, if yes, your answer, does that make you happy in terms of flows on your trading desk?
Yeah, it's a significant. I think the minister was very brave because by any estimates, I think the deductibility is about 3 billion or so, 3.6 billion loss of revenue to the fiscals. So it's one of those policies where once you have it, it's so sweet you don't let go of it because it was a bad policy that brought in so much money. So I think it's commendable. As to whether it's such a significant game changer, I think the mining industry, the mining tax policy still has challenges. So for example, you are looking at current metal prices of over 10, copper. Let's take copper, $10,000 per ton. At that rate, from 9,000 upwards, it's 10% MRT. Whether it's deductible or not, it's a top line tax. You don't want to be in a position where the investor walks away with less money than the fiscals. So what we've basically done is created a structure where if I invest $1, if I make a profit on $1, the fiscals walks away with $60. And as an investor, I walk away with 20. I've got loans to service. Most of these mines are financed by debt. Then I've obviously got reinvestment. So a lot of them have mothballed their projects because they just no money. So even the conversation of them going back to list, what return are they going to offer? What's going to make them attractive for an investor in the to buy a share in the mine? Maybe one or two mines that's operating will be attractive enough to list. The rest, there are still significant structural issues that need to be resolved.
So, and clearly Mr. Mawere has noted that we're going to see greater flows coming from the mines. So, your views on your... Yes?
Well, it's a bit of a difficult one. It depends on where those go. If they go to Mr. Manga, then yeah, it's one thing. If there are flows, whether directly or indirectly or as a result of the entire chain, we do have more flows coming through into the market, then absolutely, because then that allows us to be able to do other things apart from just the conventional foreign exchange. You know, they allow us to be able to do things such as derivatives, and these will feed into the pillar of market depth, product development. That's essentially what we want to see, because we want to start moving now. I mean, from the time that we started discussing the index, it would be nice to now make some huge strides and say, we're now seeing more of this, we're now seeing more of that. I mean, just to add some credit to the market development part, which has been supported, I think, to a large extent by Bank of Zambia, is where traditionally our market was 90-95% spot foreign exchange. That's the FX market. It was about 90-95. But about 2 years ago, it changed. It became about 65-70% spot FX, and the other part was in forward. We started seeing more forward contracts, we started seeing more swap, and that's what we want to basically see more. I mean, I'm excited as a financial market participant if I can have a whole range of products, because even as we serve the client in the end, and as we try to offer different solutions, we're not saying, well, we have to pick one of two things, but I can look from a suite of about 10 or 12 different things that I can possibly offer out there.
Thank you, Stanley. Professor, your views?
Well, firstly, I'm thrilled because I've been championing for more than 3 years now for detectability of royalty, because I think it's a cost. It had to be done away with. It's very bold. I think in the budget they estimated about 2.5 billion loss is significant. But I think the bottom line is that it may be a loss in the short term, but to the extent that it invites more investments, you'll be taxing from a much bigger base as opposed to it. It's like milking a very thin cow, and you want to get more and more milk out of it, when in fact you can have a much bigger stock where you can milk less, but cumulatively is more. So for me, it's very important, but it has to be complemented by the sliding scale. Because essentially what it means is that if you go to that threshold where it's 10%, immediately that is 10%, because it's not like you pay as you earn. You pay for 100%, the total, essentially meaning that you can have a scenario where the higher the price, the likelihood of actually the mining company paying more than their profit kicks in, because essentially you are not really recognizing that when you do it that way, you are moving up, because the scale, the thresholds, as you move up the scale, assume that actually you pay more as you go higher, rather than that you pay more, including what the allowance that was given in the lower band. There is no economic logic in that, and my hope is that the government and the mining houses will move swiftly if you really want to see exponential growth in terms of expansion. Because at the moment, the government is targeting in the next decade 3-4 million metric tons per annum, and we cannot get there until we start actually looking at this fiscal regime within the mining sector.
Thank you. So the last pillar, the possibility of standard master agreements, Mr. Uganda, is that the repo markets, no comments.
Well, I think that is again a lot of work in progress. Is continuous. We've been encouraging banks themselves as larger participants in the financial system to sign up for these things, and I think some have bilateral. Ourselves, we've signed with each one of them some of these agreements. We've signed them not because we carry credit risk. We sign them so that we can encourage the usage of them for institutions that they themselves carry lots of credit risk around them. Because most of these master purchase agreements and stuff like that tend to deal a lot with issues of credit risk. And then he had mentioned the issue of netting, which I think was a thorny in our legal arrangements. And I think that is where I'm not entirely sure where we are on, but I think we did make a lot of progress on this issue as well. So once that has been pushed through, I think it will contribute greatly to the concerns that others have.
Thank you, Director. Dr. Mwai, this question is for you. Myself, do you have anything to add to that? And to see these ESAs evolve to include ESG clauses as the world transforms and moves towards a conclusion?
Thank you again. Probably nothing more to add, but just to say that when we are able to collaborate in the and we're able to do it. And coming to the issue of the ESG, I thought it's also important that we leave this place a bit more informed in terms of what we are doing as financial sector regulators. So we have actually a tripartite working group that has been put in place where we are discussing various aspects of ESG, including how we are going to put in place a disclosure framework for the financial sector. We are also pursuing other projects within that working to do with tagging. And your point, yes, we do hope to see ESG incorporated. And also hope to see that Zambia scores far much better than it did in the space of greening. We really put our heads together with the help of the Ministry of Green Economy and technical partners such as the Biodiversity Finance Initiative. I thought I should mention that for the record.
Thank you very much. I'll take final comments. Capital Markets Association, under 30 seconds.
Well, I think we'll just want to thank Absa for the things for the very revealing report. I think for strategic thinkers and decision makers, it becomes an easier sort of source of information, which clearly peers us out with the rest of the peers in terms of how they perform. I think it's quite a very interesting report because it helps you to also see just how huge or long about your transmission mechanisms or how some of the decisions are going to make, but implementation becomes slow. So I think looking at what some of the countries are doing, it just helps us to see what we're here to do. And hopefully maybe for the conversation, we can also take it up forward and get to see that we can implement some of the things that want to show.
Thank you. Mr. Mawere.
Yeah, I think, like I said, it's important to have a conversation between, the regulators, tax, and so on. Look at, for example, withholding tax on, the fixed income market, where somebody places it through an Absa, for example, and they're in a treaty country. The system still don't stop, and the other party will not get a lower tax rate because, when Absa places those funds, they are placed in MAP, and the system doesn't identify. This one is England, where there's a treaty and so on. So it's those challenges that we need to address to increase participation in the financial markets, and everybody needs to talk. But otherwise, there's lots to be done. The report is great. It's a microscope on the challenges that we have, but also the opportunities.
And yes, I do have some final remarks. Thank you very much. Thank you. You've been very considering I'm getting twice as much time. So maybe one person remarked is basically, you need to just say that it's a fantastic report, and this time round, when I'm reading it, I was extremely excited with the findings there. I was not at all threatened by any shortcomings that is labeled on Zambia. And that's because from as far as the capital markets side is concerned, everything that they cite is actually included in the capital markets master plan. And we have a grand plan for strategy of how to address those issues. And may I also just mention that the top 3 countries, actually 4, including Ghana, that you see on the index, they all have a master plan in place. And if you follow their history, it's at least for the 3 of them, I can talk for the 3 jurisdictions. If you follow their history, when they launched their master plan, it became very clear what direction and what they wanted to see. And it became very easy to have the discourse we had here in terms of convincing the central bank what they need to do to facilitate the growth of the capital market, convincing the tax man in terms of what they need to do to support the growth of the market. That is what we envision for the next coming months and years once the master plan is adopted by Cabinet and the Ministry of Finance. We want to have this discourse. We are proposing to position Zambia as a preferred destination for investment. We want Zambia to be a hub. Whether it's green investments we're talking about or brown investment, there's absolutely no reason why Zambia shouldn't be a hub of those investments. And you will see countries that have positioned themselves as a hub of anything, whether that's a tax-free zone or whatever. They basically started by crafting their vision, believing in it, having the tough conversation, and beginning to walk the things that they want to see. And that's why you have the United Arab Emirates where they are. That's why you have Mauritius where it is. So those are my target advice. We can be the preferred destination for investment. Yes, Zambia can be a hub, even for green investments.
Thank you very much. Mr. Mohan.
Yeah. I've followed this report since 2017. It was introduced, and every time it's published, it's bringing newer and newer information. And of course, I follow it very keenly. And to the extent that it's a comparative survey, it kind of gives you an opportunity to introspect about what is it that you are doing right, and perhaps what is it that you are not doing right. What are the areas of improvement? And I think that from the discussions that we've had here, we still have quite some work to do to improve some of the metrics that apply to Zambia. So it's a pretty useful report and Zambia, and the people behind it are very good friends of mine. So I always have an opportunity to talk to them behind the scenes. Fantastic.
Thank you, sir. Professor.
I think it's a great report. I think to the extent that it's comparative, it allows countries and perhaps, for me, Zambia, to learn what others are doing and what should be done. Because sometimes you don't know how well you are performing or how bad you are doing unless you put yourself against other comparative countries. And it's usually embarrassing when you discover that in the countries that you feel they have a fraction of the resources that you have are performing better than you. You begin to actually self-introspection. Where have I gone wrong? And I think that gives it additional importance. But finally, I think to the extent that the private sector must be the driver of growth, and I think the new government here in Zambia has recognized this fact. We have to find ways and means of ensuring that there is a facilitative environment, not only broadly at the macro level, but probably more specifically for these papers. Financial markets are important because they are ultimately what fits into making things happen. So for that, I would like to thank Ms. Memo and the team, Absa generally, for supporting this kind of cause. Thank you, and for inviting me to be part and parcel of the conversation.
All right, thank you. So I guess for me, it's one report that I'm very passionate about. goes without saying, because Absa featured somewhere there, as a report is issued. I really love the fact that, the partnership with OMFIF being independent and it being, a think tank, being backed by central banks in there, giving it that independence. So it's always great to get that report coming out, because you know that while the Absa name is there, yes, there is that independence in basically conducting the survey and doing the whole thing. So because of the way it was formed, I'm really passionate about it. The big thing for me, and it's pretty much the same story as we sit here every year going through it, is to walk away with that sense of excitement and say, okay, we've got some work to do. And I always look forward to coming back the following year and saying, these are the areas where we've made some quantum leaps. And I think that more so even now, with all the changes and everything that's going on, it's given us that great opportunity to really try and drive some of these changes so that we can see that movement. So for me, I'm looking forward to seeing Zambia. I mean, we've moved from 97, but I'm seeing us in the top, at least the top 4, with significant strides in some of these areas. That for me would be the ultimate, what would really make me happy.
Thank you very much, Stanley. So to our esteemed guests and viewers, this has been an exciting panel discussion for the 5th launch of the Absa Zambia PLC, Absa Africa Financial Markets Index. So just to thank the panelists for your time, and I've been your moderator, just in case we name. I'm an economist and financial analyst. So I'll hand over to Stanley for the closing remarks.
Thank you very much. And that's it's been interesting indeed. I think I've spoken so many different parts and so much today. But I'd just like to first of all start by thanking the panel up here. You've been an absolute joy to be with. Very engaging conversation, and we look forward to you just knowing that every year it's standard around this time I'll get that call and I will say yes. So we look forward to that. Thank you so much sincerely for spending all the time with us. To Mr. Moderator, for an excellent job in what you have done in moderating for us. I'd like to thank you indeed. And of course, this is all on behalf of my Managing Director, Mrs. Misingameno, who was supposed to be here with us, but is on the other end of the technology, still here with us. A sincere thank you. And also to our clients and guests who have been online. This is one program that is followed quite closely. Would really like to thank you. And normally, as we finish the launch within the country for the specific index, there are some post-index actions that do follow on different media and different platforms. Just encourage you to basically follow as many of those as possible so that you can participate in one way or another, directly or indirectly. And indeed, to the team that has put all of this together, the team, Absa, Fortress Media, we really want to thank you sincerely, and we look forward to getting our hands dirty, getting this thing to really move to the next level, and sitting here again next year and seeing what lovely result we'll have as Zambia. So I thank you all sincerely, and Mr. Moderator, I hand back to you.
So thank you very much, and we'll see you next year.